Greetings, members one and all of the Salivation Nation. Gold-backed bonds. This is the topic of this video. Nevada legislation is proposing this way to deal with principal and interest payable in gold. Let's take a look. Yes, this is a public release from last year, actually, well over a year ago now. Don't know where it stands, but in Carson City, Nevada, Assemblyman Jim Merchant announces the Nevada Gold and Silver Enabling Act. The legislation provides the state and its municipalities a framework to issue gold and silver bonds. These bonds will reduce the state's debt, shore up the pension fund, increase mining employment and profitability, and attract capital to Nevada. A paper describing the benefits of issuing gold bonds has been published by Monetary Metals. We'll kind of take a look here. I think it's unique in some way to Nevada because they're such a large producing state. We'll explore that later too. But here it talks about issuing gold bonds. It's quite interesting because this is with the inverted yield curve happening over the U.S. Treasury T-bills. Now that is quite interesting news and how things could move in this direction. We shall see. This might be the path to a potential partial gold standard. Who knows? We shall see, or at least a path towards it. We'll see. The gold bond is debt obligation that is denominated in gold with interest and principal paid in gold. As explained below, it's a way for the issuer to pay off its debt in full. And there are other advantages. And here we can see a gold bond from days gone by there. New York Central and Hudson River Railroad Company. Very cool. It's bought by the president and fellow of Harvard College on the 25th of November, 1905. It's $5,000 payable in the gold coin of the United States of America. That coin was a Liberty head. The double eagle $20 coin had just under 1 troy ounce and or 0.05 ounces per dollar. Thus, $5,000 meant 241 and 7/8 ounces. The interest rate was 3.5%, paid semi-annually until the principal was to be returned on the 1st of February 1998, a 92-year maturity. This may seem incredible, but the gold standard had a stability that we can only dream of today. Boy, isn't that the case? Isn't that the truth? Unfortunately, less than 30 years later, President Roosevelt decreed all gold clauses void. In 1998, assuming the bonds hadn't defaulted, Harvard was finally paid $5,000. That's a loss of 93% of its original investment, as it was then worse than less than 17 ounces of gold. There has not been a gold bond in the U.S. for 85 years, yet a government, which I believe I'll be able to talk about soon, is moving towards issuing gold bonds, and that's talking about Nevada. And there's a benefit to the government. It says the Federal Reserve has a policy of 2% per annum debasement of the U.S. dollar. That's inflation rate. Other central banks around the world have similar targets. For example, both the Bank of England and the European Central Bank set their targets at 2%. Creditors should prefer gold assets over dollar, pound, or euro-denominated assets because gold is not subject to this debasement. The 10-year Treasury yields 2.9% as the author writes this, assuming that the Fed has hit its target without overshooting it. Then the central bank is robbing the investor of most of their return. However, this leads to a question. For every reason what that creditor should avoid dollar assets, shouldn't debtors prefer dollar liabilities? Isn't it good to borrow in a falling currency? Repaying in devalued dollars should ease the burden of debt. In 2001, the dollar was worth over 122 milligrams of gold. By 2011, it had declined to less than 16 milligrams. Any gold producer who borrowed dollars in 2001 could repay that debt for 87% less gold. And so the thing is, the problem is matching gold debt to gold income. The decline is not smooth, it's quite volatile. The dollar can go up sometimes sharply, as in 2013. By 2015, the dollar was up to about 30 milligrams, Any gold producer who borrowed dollars in 2011 would have to pay 90% more gold just 4 years later. If a debtor has dollar income, as nearly everyone does, then it can ignore the dollar's ups and downs. When the dollar goes down, both income and expense goes down. When the dollar goes up, income and expenses go up. However, if your income is gold, then any drop in the price of the metal can strain your capacity to pay your dollar debts. A falling price of gold is just a flip side of a rising dollar. Debt should be matched to the income that services it. If the income is gold, then the debt should be gold. And if you're a government which taxes gold mining activity, your income is gold. This is true whether the tax is remitted in gold metal or whether the miner pays the equivalent value of the metal in dollars. If the price of gold drops, then your revenue drops. If you have dollar-denominated debt, then a gap will open up in your budget. By issuing gold bonds and replacing dollar-denominated debt with gold debt, the government stabilizes its debt obligations and de-risks its debt service. If the price of gold goes up, or if it goes down, then the tax revenues and debt payments move together. It's always good to reduce risk, but doubtfully so our present economic environment. So it provides there's more things it talks about as a mechanism to get out of debt and lower interest expenses, and there's some other benefits to gold bond issuer. The state of Nevada is a mining state, and so this is especially would be a very good situation for Nevada where gold miners can benefit. And this article goes on to talk about how the gold miners can pay their taxes in gold. Let's talk about that mining in Nevada. There's a next major gold deposit. This was about a month ago, where it talks about every day it seems a new concern emerges to cause further uncertainty for investors, including geopolitics, trade wars, unemployment, inflation, recession, interest rates, and more. It's a long and seemingly ever-growing list of things investors need to account for. The U.S. and China are caught up in an escalating trade war. Each side seems to want to up the ante, threatening higher tariffs or hundreds of billions of goods and services. Stocks and bonds have grown volatile as the investment outlook gets cloudier. For the first time in years, the markets are starting to price in interest rate cuts by the U.S. Federal Reserve. And that's for sure that baking in that I've talked about so many times. Many of us here in this community have referred to. It's led to something known as an inverted yield curve, and bonds a reliable predictor of economic recession within the following 12 to 18 months. Gold is widely recognized as having intrinsic value and has been considered money for thousands of years. It's no wonder central banks hold it as a foundational reserve asset, now a Tier 1 asset after the Basel III. And so I think that gold is positioning itself in a good position now, and it's quite surprising considering all the digital assets out there. Everybody's going back to the old standard true, and that is the gold standard. Whether or not we recognize it in terms of basing our monetary system on or not, obviously these central banks around the world, and even here in the United States, we have the largest, we value it as a nation, as people, and as policy. As one of the most prolific locations to find gold is Nevada. It's endowed as one of the most mineral-rich areas on the planet. Nevada is top North American gold mining district. In fact, if Nevada were a country of its own, it would be the fourth largest gold producer worldwide, behind only China, Australia, and Russia. That's amazing. The state produced 5.5 million ounces of gold in 2016 and has yielded an incredible 225 million ounces total to date. Nevada currently produces 80% of U.S. gold. That is fascinating. According to Fraser's Institute annual survey of mining companies, 2018, Nevada ranks as the top mining jurisdiction based on investment attractiveness. So then talks about the Barron Mining Corporation there and how it's in the middle of Nevada. And it talks about another prospect for gold mining. And see, the thing is here from these maps and geological studies, we can see there's more potential for more mines, for more mining and more gold exploration there, which sets up Nevada to be a great test bed for this gold-backed bond here. And that brings us back to this legislation, a nonpartisan legislation, does not force us to use gold and silver, says bill sponsor Jim Marchant. I'll add here and interject that Nevada is the silver state. It is a silver producer as well. It simply highlights this option for the state and municipal treasurers who are empowered to decide for themselves. It makes sense to replace dollar-denominated debt with gold bonds so the obligation is matched to the source of income, said Keith Weiner, an economist and CEO of Monetary Metals. The bill also allows miners to pay tax in gold and silver. That tax is currently in the hundreds of millions of dollars or several tons of gold. By paying directly in metal, mining companies can save money. Very interesting. That's cool. The act, and by the way, it recognizes and it gives nod to the Constitution, which states specifically that gold and silver in the state shall be money. The act builds on precedents set over the past several years by related legislation adopted by the states of Utah, Oklahoma, Texas, Arizona, and Wyoming. Under existing federal law, gold and silver coins issued by the U.S. Mint are legal tender. Anyone has the right to tender them in payment for debt and taxes. However, they'd be a fool to do so, because if you take a $50 U.S. gold buffalo or eagle and cash it out or use it to tender for payment, you're going to be sorely disappointed in the return because you're trading in about $1,500 worth of gold under a coin that's denominated $50. So very interesting indeed. And I don't know what the status of this legislation is, but I think it is fascinating, especially considering that that you have a state, Nevada, such a large producer of gold, 80% there we talk about. So it'll be interesting to see. I think it's going to be fascinating to see where this goes. I've not been able to find if it's been signed by the governor or if it's enacted yet. But I do think it's quite interesting that other states have already adopted them, such as Utah, Oklahoma, Texas, Arizona, and Wyoming. Very cool and interesting indeed. So post your thoughts below. Would like to extend a multitude of gratitude to you all for watching and encourage you to please rate, share, comment, and subscribe.